All right, so this is the consumer defensive sector, and the consumer defensive sector used to be really more defense companies, military, and the reason why is because consumer defensive means a company, industry, a business that is needed throughout the year, doesn't change, right? Time of year doesn't really matter, weather doesn't really matter. This particular industry is going to just kind of do the same thing all year long. These are usually companies that don't grow very much in price. They kind of act like utilities in that respect, but they're still profit driven. You know, they don't really know what they're going to make, but whatever they do make is fairly consistent. And so, what we have here is CPB, Campbell Soup, Cisco, and we have oh, I can't think of the name. Where is it at? I want to say Palm Olive, but that's not it. Let's take a look. So we got Campbell Soup. We have Colgate-Palmolive. There we go. All right. So this was actually not an easy decision to make. So let's go through these kind of side by side and see where we are. So first off, Colgate-Palmolive definitely benefited from COVID, being cleaning supplies and whatnot. A lot of people stocked their shelves or stocked their pantries rather with products from this company. With the impending doom that was COVID-19 back in January and February. So we see that their net profit has grown over this year, so that's really good. But you know, going back over the last 3 years, you see that they've improved slightly on their revenue year over year. So that's really good. Looking at Campbell Soup, same thing, right? I mean, I remember going to the grocery store back in February of this year, and I mean, the shelves were just empty. I mean, all of the canned goods were gone, all of the dry noodles were gone, pasta was gone. So, of course, you know, Campbell Soup benefited greatly from COVID as well. But again, you can see over the last couple of years, their revenues have varied a bit, and you know you can argue varied quite a bit actually, based on this visual chart here. But again, they've grown fairly well, and I think they've done a decent job with managing that net profit, as you can see there. And then we have Cisco, which has done the opposite. Now, Cisco doesn't deal with food so much, more than they do products. And so even though those products are still needed, still a staple of anyone's shopping cart, I don't think they were as needed as some of the cleaning products and things of that nature. So you can see here that their net profit has actually dropped quite a bit. And so that was just one reason why, you know, I didn't even look at Cisco. Let's take a quick look at my notes here. Cisco, more cash, less debt. Earnings, of course, are an issue. Colgate-Palmolive, better profit, but did not make it onto any portfolios, which means they really just didn't stand out in any one category as a performer. So let's take a quick look at what that looks like for those companies. And I don't remember how many companies we have in the defensive sector. I know there's a bunch of tobacco companies. Okay, so it's not that bad. We were in Target previously. Target's done really well for us, and as you can see, it outperformed everyone, especially with COVID. It really outperformed and did really well. But the price has gone up way too high, and so it's no longer investable for us. And so we actually sold out of our position, and so we're looking to add a new position. Colgate-Palmolive, second best return, which is why we're looking at that company. And you can see Campbell Soup, not a great return, but has been an MVP 4 out of the last 12 months. And so that means something. It means that Campbell Soup ticked off some boxes to make it onto the best performing portfolio 4 out of 12 times over the last 12 months. And that's something that we look at. So let's take a quick look at those portfolios to see how they performed and exactly which portfolios they performed well in. So we have this one, Campbell Soup. This particular portfolio, this is the exact same portfolio that actually did the best 2 months in a row. So that's definitely something to look at. And then we have Campbell Soup again down here, which is again on this same portfolio. So there's only really 2 portfolios that Campbell Soup showed up in that performed the best. Let's take a look and see what those are. And I'll look at the most recent one here, if we can find it. So 176, everything else is negative. And so right away, I'm going to assume that a portfolio that had a nice return when the rest of the market seemed down, it's going to be something like a beta. Oh, no, never mind. Here we go. Yeah, 3%. And so, yeah, I mean, that's exactly what I expected. So the beta portfolio is what's going to perform well when the rest of the market is not doing so well. And that's a great attribute to have in a company. So let's take a look now back at this one. And again, this is a month that the rest of the market looks like it's sold off because everything is negative. Let's see if we can find any positive returns for any portfolios this month. So far, I don't see. Oh, there's one, 0.64, which is close to zero. But what that means is you don't lose any money when the rest of the market is. Let's see. Yeah, it looks like that is the best performing portfolio. And that was in February. So that was in really the middle, or the beginning rather, of this whole COVID thing. And again, so we see this beta and down portfolio. Now, my concern here is that we're trying to mimic a return portfolio. And in that portfolio, we have Cisco, okay? But going back and looking at Cisco, they aren't performing very well. It definitely gives me some pause. Let's take a look at the fundamentals and see how these companies stack up amongst each other. Cisco. Campbell Soup. And we have Colgate-Palmolive. Bunch of CLs in there. Okay. All right. So right away, just looking at price performance, looks like Cisco is up a bit. Colgate is way up, and then Campbell Soup is up a little bit. So that's good. I mean, it means that these companies have performed fairly well. Campbell Soup has a bit larger dividend. It's always good to see, especially when you have an increase in price. And with that being said, though, the fact that Colgate-Palmolive's dividend is so much lower is a direct cause of the price going up so high. So unless Colgate-Palmolive raises their dividend, and if the price keeps going, then this company won't even be investable for us because we only invest in companies paying at least a 2% dividend. So that's one thing to be aware of for sure. Um, and of course, Campbell Soup's going to have a much lower PE than Colgate-Palmolive, primarily due to price for sure. One thing to mention here, I think is important, is that these 5-year highs is, the highest that the PE has been over the last 5 years, and we see that Campbell Soup has been really high, and I'm going to assume that that was very close to when Campbell Soup had that great advertising and marketing campaign with the football players' mothers. That was a really awesome thing. I don't know what, if anything, they'll come up with next, but that was really awesome. And so you see the PE was way up there at 80, and now it's way down to 8. So either that means the price has come way down or earnings have gone way up. Okay. And based on what we see over the last 4 years as far as earnings go, um, that's not the case. So the prices had to come way down. And so I want to take a quick look at that. Let's just take a look at this chart and see really what it has done over the last 5 years, maybe. Okay. And so right away we see the price has not um, moved around much at all. Matter of fact, it's dropped off quite a bit going back to 2017 from a price of $63 down to 48. And now what I like to do is overlay this chart with our Colgate Palmolive. And let's just see just how big of a difference um, we're looking at as far as price goes. And so again, this is going to be roughly what? It's only a year. Let's go back a little further. Go back just a little further. All right, and we see over the course of 5 years, Colgate-Palmolive has more than doubled the performance of Campbell Soup. Um, and so now if we take this back to the last 2 years, takes us back to the last 2 years, you see that Campbell Soup has actually outperformed Colgate-Palmolive, and right now, if you go 2 years back to now, they're really at the same place, and so that's important, right? Whenever you're looking at data, it's important to get a nice data set, right? So you want a lot of data there, but depending on how far back or how close you're looking can drastically change the way things appear. And so for us, we use a 3-year period to look at everything, and that 3 years has a lot to do with number theory, right? First time is a fluke, second time is a coincidence, 3 times is a pattern, right? 3 times it's true, kind of what they're saying, right? And 7 times is supposedly perfect, but the problem with looking at 7 years, you're talking about at this point 2013. I mean, that's a totally different economy, right? I mean, 7 years is a totally different time, and so we don't want something that happened 6 years ago, affecting the data that we're looking at today, right? So we want something much closer to what's going on now. And so that's the reason why, again, you see these huge differences between the 5-year and the 2-year. So just for fun, let's look now at a 1-year and see what that looks like. And we see Colgate-Palmolive has drastically outperformed Campbell Soup there. And now let's go to the last 6 months, which is all COVID related. And you see that Colgate-Palmolive again outperforming Campbell Soup. And, I will say that this is a direct reflection on, again, our economy and kind of where we are. Colgate-Palmolive is a cleaning supply business. And if there's ever been a time to be in cleaning supplies, it is definitely now. Will that continue? No, of course not. I mean, at some point, things are going to go back to normal, and you won't see this influx that we see now in cleaning products. And the same can be said of canned foods as well. Even though both are staples of anyone's shopping cart at the grocery store, we have to really dig into what company we expect, what company is performing better now, what company will perform better going forward. So let's take a look now, again, at some numbers just side by side here. Going back to the PE, Colgate-Palmolive is definitely closer to its high. It is really at its lows. And so what that means is that typically speaking, Colgate-Palmolive does not get any lower than that 21. And the same is said of Campbell Soup. 5 years, 11, and it's currently at 8. And so what that means is that these companies are really cheap relative to what their price has been in the past. And again, that is indicative of either the price coming way down, which we've seen, right? Or earnings coming way up. So clearly, prices coming down has changed these PEs. Campbell Soup looks like it's going to be a bit cheaper than Colgate-Palmolive. And I know saying a bit cheaper relative to the numbers you're seeing here, but the PE is not what's the word I'm looking for? It's not a straightforward number to really look at in those terms, especially when you're talking about a 5-year high or 5-year low. It's just kind of a roundabout figure to give us a relative idea of where the price is and where the earnings are relative to previous years. All right, so that looks like net profit for Colgate-Palmolive, much better. A whole bunch of cash on the books over at Cisco. CPB, definitely more cash than Colgate. And I think there's something to say to that, being that they really are. I mean, one is food, one is chemicals, but the fact that CPB has so much more cash on the books means that either they're holding cash for some reason, or maybe that they just have more cash coming in on a continuous basis. And of course, because they have more cash, the cash to debt ratio is going to be a bit higher, but it's not double what Colgate is, which lets me know that Colgate has less debt. So that's a good thing. Another thing here to really pay attention to is the short interest on Campbell Soup is much higher. And so what that means is there's a lot of people out there, well, not a lot, let's just say relatively more people that think that Campbell Soup is in a bad situation versus Colgate-Palmolive. And so that's definitely something that we're going to take a look at. Colgate-Palmolive, much better alpha, um, which again is a good thing. When the stock market is doing well, Colgate is going to do a bit better than Campbell Soup. It is important to mention, however, that being that this is consumer defensive sector, you're not going to get a lot of alpha out of these companies. Okay, these are huge companies that really don't move around a lot in price, and so even though Colgate has a better alpha than Campbell Soup, they're both negative. All right, so what that means is when the market is doing really well, these companies actually lose a little bit of stock price. Okay, Colgate is much better, however, on the down moves, and so again, what that means is when there's a lot of buying and selling going on, the Colgate tends to lose less stock price than Campbell Soup. All right, let's look. The beta for Campbell Soup is going to be much better. Now, what that means in regards to Colgate having a higher down score and a lower beta, I'm not entirely sure. It may have something to do with institutional ownership because the down moves is based on trading volume. Okay, and so beta is when the rest of the market is doing bad, these companies tend to do a bit better. But maybe that's when it's just, normal, everyday buying and selling. When there's a lot of buying and selling, we tend to have a better day with Colgate. The 1 month return is better with Colgate. That's, of course, we saw that looking at the price charts. Volatility is about the same. Looks like Campbell Soup is a bit more volatile, which means it's going to move around a lot more as far as the price goes. And I'm going to say that that's probably going to go hand in hand with the short interest because when you have a lot more people betting on a stock losing money, that's going to move the stock price around a bit more. And Colgate-Palmolive has the worst M score out of the rest of these companies. But as I've discussed in previous videos, that's not necessarily a bad thing, simply because we've seen those M score portfolios perform the worst out of all of the other portfolios. And that score is really based on cash on the books and debt on the books. So let's take another look. Where I looked at that. Take another look at our numbers here. All right. So price to book 5 times for Campbell Soup versus 111 times for Colgate-Palmolive. Now, I've discussed this before. A lot of times this has to do with the market's confidence in a company. When someone is willing to pay 100 times more than what the company is actually worth on paper, means that people really believe in this company. Now, I am curious as to what the price has been recently as far as let's take a look here. And we'll do another 5-year just as a good comparison. And we remember with Campbell Soup, up back here in 2017, we were up like $60 and now we're down to 40 compared to where we were with Colgate at 70, now we're up to 85. So this company the stock price has continued to increase while Campbell Soup stock price has continued to decrease. And so that's going to play a lot into why you're paying 100 times more um, what the company is worth um, on paper. We also have current ratio close to 1, so that's the same. Price to sales is 4.5, and Campbell Soup only 1.5. And so again, this is directly related to the confidence that people have in this company. My main concern here is that you have really kind of a high flying stock with Colgate-Palmolive um, versus a cheaper, more reserved company in Campbell Soup. And so we're going to continue to monitor this. As of right now, we do have Campbell Soup as the clear winner here. And I mentioned the reason earlier is that Campbell Soup has made, the MVP 4 out of 12 months. And the reason for that is because of the beta that Campbell Soup has. It doesn't seem like, numerically, it doesn't seem like it makes a big difference, but it is double, right? When you talk about 0.006, 0.003, it is double. Now, it'll be really nice to replace Colgate-Palmolive with Campbell Soup in those same portfolios and see what the difference in performance will be. I'm sure it'll be actually a bit more, but without being able to do that, I have to kind of go with what we have in front of us, and that is Campbell Soup making those portfolios, ticking off all the right check boxes to get onto those portfolios and then perform in them. And so that's what we're going with, Campbell Soup. But again, it's something that we'll continue to monitor. It will be a smaller position for us, so we're not risking too much. And so we'll go on a month-to-month basis and just kind of see where we are. And while we're waiting, we'll have a decent dividend, 3%. I think currently, let's take a quick look at this. I think the last time I looked at it, we're going to actually get paid out, I think in January. Let's check though. Curious. Yeah, so we'll get a nice dividend in January, and we'll kind of reevaluate in February and decide if we're going to stay in Campbell Soup, we're going to get out, or add more, or sell some. But that's it, Campbell Soup.